Hey, welcome back. Let me ask you something. Have you ever looked at a price chart and noticed that price keeps coming back to the same specific zone over and over again? Not just a support or resistance line, a specific area on the chart that price respects repeatedly, sometimes weeks or even months later. And you thought to yourself, why does price keep reacting at that exact level? The answer is order blocks. Order blocks are one of the most powerful and most misunderstood concepts in all of technical analysis. They are the specific price zones where institutional investors, the big banks, the hedge funds, and the largest trading firms in the world placed their massive orders. And because those orders are so large that they cannot be filled all at once, price has to return to those zones multiple times before the full position is filled. When you learn to identify order blocks, you are essentially learning to see the footprints that institutional money leaves behind on every chart. And when you trade those zones, you are trading alongside the biggest players in the market instead of against them. By the end of this video, you will understand exactly what an order block is and why it forms. You will know how to find bullish and bearish order blocks on any chart. You will understand what makes a valid order block versus a weak one. And you will have a clear strategy for trading order blocks with precision and confidence. Let us get into it. What is an order block and why does it form? Let us start from the beginning. An order block is a specific area on a price chart where a large institutional order was placed before a significant price move. Think about what happens when a major bank or hedge fund wants to buy or sell a very large position in any asset. We are talking about positions worth tens of millions or hundreds of millions of dollars. They cannot just place the entire order at once. If they did, their own buying would push the price up dramatically before the order fully filled, or their selling would push the price down against them. This is called market impact, and it is a serious problem for anyone moving that much capital. So, what do they do instead? They split their order into many smaller pieces. They place orders over a range of prices within a specific zone. They buy quietly and methodically without drawing too much attention. But here is the thing. Even when they split the order, they cannot always get everything filled in one pass. The price moves before all of their orders are filled. So they leave unfilled orders behind at those price levels. And those unfilled orders sit there waiting for price to return to that zone so the rest of the position can be filled. When price eventually returns to that zone, the institutional orders activate again. Price reacts strongly because of the size of those orders. And that reaction is what creates the pattern we call an order block. In simple terms, an order block is the last candle or group of candles before a major move. It marks the zone where institutional money was accumulated, and it is a zone that price is very likely to react at when it returns. Bullish order blocks. Now let us talk about the two types of order blocks. We will start with bullish order blocks because these are the ones most traders want to find first. A bullish order block is a zone where institutions placed large buy orders before a significant upward move. Here is exactly how to identify one. You are looking for the last bearish candle, meaning a red candle, before a strong and significant bullish move begins. Let me walk you through why this specific candle matters. Just before a major move upward, institutions are quietly accumulating their buy positions. They are buying while the price is still moving down or sideways. The last bearish candle before the big move up is often the final stage of that accumulation. It is the candle where institutions placed their last and often largest batch of buy orders right before pushing price aggressively higher. That candle and the small zone it covers from its open to its close becomes the order block zone. When price later returns to that zone, the remaining unfilled institutional buy orders activate. Strong buying pressure enters the market. Price reacts and moves back upward. Here is what makes a bullish order block stronger and more reliable. The stronger the move that followed the order block originally, the more significant the institutional activity was at that level. A bullish order block followed by a massive aggressive move up is far more significant than one followed by a gentle, slow drift upward. The more untested the zone is, meaning the fewer times price has returned to it, the more unfilled orders still sit there. A fresh order block that price has never revisited is stronger than one price has already partially tested, and a bullish order block sitting within a broader bullish market structure is far more likely to hold than one forming during a downtrend. Bearish order blocks. A bearish order block is the mirror image of what we just covered. It is a zone where institutions placed large sell orders before a significant downward move. Here is how to identify one. You are looking for the last bullish candle, meaning a green candle, before a strong and significant bearish move begins. Just before a major move downward, institutions are quietly building their sell or short positions. They are selling while price is still moving up or sideways. The last bullish candle before the big move down is often where institutions place their final batch of sell orders right before pushing price aggressively lower. That candle and the zone it covers from its open to its close becomes the bearish order block. When price later rallies back up into that zone, the remaining unfilled institutional sell orders activate. Strong selling pressure enters the market. Price reacts and moves back downward. Here is the practical application of bearish order blocks. If you are in a trade and price rallies back into a bearish order block above your entry, that is a strong signal to consider exiting or tightening your stop. The institutional sell orders sitting in that zone may cap the move and push price back down. If you trade on the short side, a bearish order block in a broader bearish market structure is one of the highest probability zones to look for short entries. And even if you never short the market, understanding bearish order blocks tells you clearly where not to buy. Do not buy into a clearly identified bearish order block. Wait to see how price reacts there before committing. How to identify a strong versus weak order block. Not all order blocks are equal. Some are powerful zones that price respects consistently. Others are weak and get broken through easily. Here is how to tell the difference. Quality factor number 1. The strength of the move that originated from it. If an order block gave birth to a powerful explosive move, that indicates significant institutional activity. Large orders created a large reaction. That zone is likely to hold significant unfilled orders. If the move that followed was slow and weak, the institutional activity there may have been minimal. That order block is less reliable. Quality factor number 2. How fresh the order block is. Every time price returns to an order block zone and reacts from it, some of the resting orders there get filled. The more times price has visited the zone, the fewer unfilled orders remain. A fresh order block that price has never returned to since the original move is the highest quality setup. A zone that has been tested 4 or 5 times already has far fewer orders remaining and is much weaker. Quality factor number 3. The alignment with higher time frame structure. A bullish order block sitting within a clear higher time frame uptrend is high quality. The broader market momentum supports the reaction. A bullish order block forming while the weekly chart is in a clear downtrend is low quality. You are fighting the bigger picture. Always check what the higher time frame structure is saying before trading any order block. Quality factor number 4. the presence of a liquidity sweep before price reaches the order block. When price sweeps a liquidity level just below a bullish order block before reacting, that combination of liquidity sweep plus order block reaction is one of the most powerful setups in institutional trading concepts. The sweep clears out the stop losses. The order block provides the fuel for the reversal. How to trade order blocks step by step. Now let us put everything together into a clear step-by-step process for trading order blocks. Step 1. Identify the higher time frame trend. Before anything else, look at the daily or weekly chart. Determine whether the overall market structure is bullish or bearish. You want to trade order blocks in the direction of this higher time frame trend. Bullish order blocks in uptrends. Bearish order blocks in downtrends. Step 2. Find the significant order block on the chart. Look for the last bearish candle before a major bullish move for a bullish order block. Look for the last bullish candle before a major bearish move for a bearish order block. Mark the zone from the open to the close of that candle. That is your order block zone. Step 3. Assess the quality of the order block. Ask yourself these questions. Was the move that originated from it strong? Is this zone fresh or has it been tested multiple times already? Does it align with the higher time frame structure? Are there any liquidity pools nearby that price might sweep before reacting? Only proceed to step 4 if the order block meets at least 3 of these quality criteria. Step 4. Wait for price to return to the order block zone. Do not chase price. Do not try to predict exactly when price will return. Mark the zone. Set a price alert if your platform allows it, and wait. Step 5. Look for a confirmation signal within the zone. When price enters the order block zone, you need a confirmation before entering. Do not just buy blindly because price touched the zone. Look for a strong rejection candle, a bullish engulfing candle, or a large bullish wick rejecting from the lower boundary of the zone is a strong confirmation signal for a bullish order block. Look for a shift in the lower time frame structure within the zone. If the 5-minute or 15-minute chart shows a change of character from bearish to bullish, while price is inside the order block zone, that is a powerful entry signal. Step 6. Enter the trade with a defined stop and target. For a bullish order block, your entry is at the confirmation signal within the zone. Your stop loss goes below the low of the order block zone. If price trades below the full order block zone, the institutional orders there have been invalidated and the setup is no longer valid. Your target is the nearest significant resistance level or the previous swing high above. Aim for a minimum risk to reward ratio of 1 to 2. 1 to 3 or better is ideal. Step 7. Manage the trade with patience. Order blocks do not always react immediately. Sometimes, price will consolidate within the zone for a period before moving. Stay in the trade as long as price respects the order block zone. Exit if price closes convincingly below the full zone. Common mistakes when trading order blocks. Let me save you from the mistakes that most traders make when they first start using order blocks. Mistake number 1. Trading every order block regardless of quality. Not every last candle before a move is a meaningful order block. Not every zone is worth trading. The quality filters we covered in part 4 exist for a reason. Only trade order blocks that tick multiple quality boxes. Being selective dramatically improves your results. Mistake number 2. Entering immediately when price touches the zone without waiting for confirmation. Price entering an order block zone does not guarantee a reaction. Sometimes price will slice straight through. Always wait for a confirmation signal, a rejection candle, a lower time frame structure shift, something that tells you the orders in that zone are actually activating. Mistake number 3. Placing the stop loss too tight inside the order block. The stop goes below the entire order block zone, not just below the entry candle, not halfway through the zone, below the entire zone. Because if price breaks the full zone, the institutional orders there are gone and the setup has failed. Mistake number 4, ignoring the higher time frame context. A bullish order block in a bearish market is a low probability setup. Always trade with the higher time frame trend behind you. The order block provides the entry location. The higher time frame structure provides the directional edge. Mistake number 5, not letting winners run. When price reacts from an order block with strong momentum, that momentum is driven by institutional orders. Those orders tend to push price to the next significant level. Set your target at a meaningful level and do not exit early just because the trade is in profit. Let the institutional momentum work in your favor. Let me bring this all together. An order block is a specific zone on the chart where institutional investors placed large buy or sell orders before a significant price move. Bullish order blocks are the last bearish candle before a major move up. They are zones where institutions accumulated buy positions. Bearish order blocks are the last bullish candle before a major move down. They are zones where institutions accumulated sell positions. The strongest order blocks are fresh, produced a powerful originating move, align with the higher time frame trend, and sit near a liquidity level that price may sweep before reacting. Your trading process is systematic. Identify the higher time frame trend, find the order block, assess its quality, wait for price to return to the zone, look for a confirmation signal, enter with a stop below the full zone and a target at the next significant level, and avoid the common mistakes. Do not trade weak order blocks. Do not enter without confirmation. Do not use stops that are too tight. Do not fight the higher time frame trend. And do not exit winners too early. When you combine order blocks with market structure and liquidity concepts, you have a complete institutional trading framework. You are no longer guessing where price might react. You are identifying with precision the exact zones where the biggest players in the market are most likely to step in. That is a genuine and significant edge. If this video gave you a clear understanding of order blocks, please hit the like button and subscribe. This kind of content takes real effort, and your support is what makes it possible. Drop a comment below and tell me this. Have you seen order blocks on your charts before without knowing what they were? Look back at a few recent charts and tell me what you find. I will see you in the next one.